The Australian Financial Review.
For years, Macquarie Group steered clear of Australia's local bank customers, focusing instead on its more lucrative deal-making, trading and asset management operations. But over the past decade, it changed course. Macquarie is on the march in both the home loan and deposit markets, and the big banks are taking notice. UBS analysts estimate Macquarie could overtake ANZ to become the nation's fourth largest home lender in about 4 years.
I think the big four banks sort of hoped that Macquarie would have a limited role as a disruptor in the mortgage market once upon a time. But all of a sudden they're at 7% and they're growing fast. And history says you ignore Macquarie's competitive threat at your peril.
Welcome to The Fin. I'm Lisa Murray. This week, Associate Editor Joyce Moullakis and Chanticleer columnist James Thomson on how Macquarie crashed the Big Four's mortgage party, why deposits are next, and whether the bank bubble is about to pop. It's Thursday, June 11. Hi Joyce, hi James, thanks for coming back on the podcast.
Thanks, Lisa.
Thanks for having us, Lisa.
Joyce, you've written a book on the Millionaire's Factory. When they started out, retail banking wasn't a big part of their plans. How and why did that change?
Well, basically, Macquarie started in 1969 and they were an offshoot of a UK investment bank called Hill Samuel. They were very focused just on investment banking and trading. Now, it was a very small group and they were trying to gain traction in those key areas. But it was when the market sort of started to change and Paul Keating started deregulating the banking sector that Macquarie thought from a competitive perspective, they needed a banking licence to stay competitive versus their key rivals. And that was really a key turning point for them. They applied for a licence, they were granted one, and their first foray into a banking-style product was the Cash Management Trust. There was a rush of demand for that product. They were able to build up significant market share by offering rates that were above savings rates at the time. They were basically pooling funds to buy bank bills, and that was based on products that were available in the US at the time. So it was sort of an innovation for this market. It gave Macquarie confidence that they could innovate and start new banking-like products. And then in the early 90s, John Simond was starting to make waves with Aussie home loans in the market. Macquarie approached and said, hey, we can fund you and provide you bigger funding lines than you actually have at the moment, where the loans are branded Aussie, but Macquarie's writing the mortgages in the background and also selling tranches of those mortgages to investors. So very soon, Aussie John was a household name.
I want you to ring your bank and demand a better deal.
Lisa, you remember the ads on television.
And if they won't come to the party, at Aussie, we'll save you.
And it became a really successful partnership. Banks had to respond because Aussie John was offering interest rates that were 3 percentage points below prevailing standard variable rates. So it was a meaningful drop. He basically did disrupt the mortgage market and the bank's stranglehold on mortgages. The banks were forced to respond and that brought interest rates across the market down. It was a real key moment for competitive activity. That all changed though when the GFC hit. Funding markets and securitisation markets seized up. Macquarie was essentially fighting for survival. The stock was being shorted aggressively. They were cutting staff, selling off businesses where they could, and they had to hit pause on their mortgage market ambitions.
Those were the dark days for Macquarie, Joyce, and it wasn't really until 2012 that they moved back into home loans in a meaningful way.
Yeah, that's right. By about 2012, funding markets had normalised. Home loan margins were starting to look attractive again. So Macquarie decided to dive back in, and that was largely through another disruptor in the home loan market, Mark Bouris. Now, Bouris, as we know, is a master marketer, and he founded non-bank lender Wizard Home Loans, which he sold to GE for $500 million. He came out all guns blazing.
We're going to take market share away from the big four.
Through a partnership with Macquarie.
The fifth pillar is here to take some of that profit and hand it back to consumers.
And was basically saying that through this partnership, they could become the fifth pillar in the banking market for home loans. And that really sort of attracted a lot of headlines and a lot of attention. It wasn't really Macquarie's style, though. Macquarie's style was typically to be more understated and let the results speak for themselves in the home loan market. But they did get it going, and there was a lot of fanfare. Macquarie really put its money where its mouth is, if you like, by taking an 8.4% initial stake in Yellow Brick Road, which is Bouris's Mark II in the home loan market. And Nine Entertainment, which now owns the Financial Review, was also an investor. So Macquarie was really white labelling the mortgages. So they were writing the home loans, but they were branded Yellow Brick Road. And Macquarie was doing it for some other players as well by this stage. And basically they were back in the mortgage business.
I think one of the other things that you've got to remember is the context of the GFC. So Macquarie came out of the GFC not in amazing shape. There was some real moments of nervousness for Macquarie during the GFC, like there was with all global financial institutions. But the solution to this, I guess, from the then CEO Nicholas Moore was to build up what he called his annuity-style businesses. While Macquarie's sort of best known as the millionaire's factory, investment banking and commodities trading, what Nicholas Moore wanted was a few businesses that were a lot more steady, reliable, that would just grind away year after year. Now, asset management was one of those, but the Macquarie team saw the ability to turn the mortgage business, banking and finance more generally, into an annuity-style business that could just sort of tick along every year, growing steadily and providing, I guess a bit of ballast for the Macquarie results, which was really important in winning back investors' trust after that difficult GFC period.
And at what point did Macquarie decide to have a crack at the mortgage market all on its own, using its own brand? How did it go about that?
Well, the Yellow Brick Road business was sort of chugging along and doing okay, but it never really gained a lot of traction. So it was around 2013-14 that Macquarie sort of thought, well, what about our own brand? Could this be a strong retail brand? There had always been some scepticism around that because, investment banking and investment banks aren't really synonymous with being the friend of a consumer and being a consumer brand. But Nicholas Moore and Greg Ward fleshed this out a little bit.
Macquarie Bank has thrown down the gauntlet to its competitors in the fixed rate space.
And thought, well, let's give this a go.
It has now got the lowest fixed rate on our data.
And Macquarie decided to try and get out ahead of the pack and build a brand in retail banking.
And Joyce, they leveraged off the success factor, didn't they? A successful investment bank, why not have your home loan with them?
Yeah, and I think they brought in some consultants from Boston Consulting Group and they were really sort of thinking they did have belief in the brand, that it could work, and that's why they forged ahead down that path, Lisa. They were sort of making these important strategic decisions and they had a plan, and the plan was, well, how can we actually build something that's different, more efficient, is not based on legacy systems? And they basically thought, we don't want to sort of look here at the big four banks and try and emulate or improve on what they're doing. They wanted to look overseas at some of the US tech giants like Amazon, Google and Netflix and look at how they were engaging with customers and what the digital experience was like with customers. Macquarie's head of banking and financial services by that time, Greg Ward, and the head of strategy, Ben Perham, travelled overseas and they met with a lot of tech companies actually and even a few global banks that were deemed to be sort of successful in technology.
And we really focus on having a technology culture. I think that's been a key differentiator in technology.
And tried to figure out how Macquarie could become a really strong challenger brand in retail banking and first off via mortgages.
I mean, by having ways of working and a culture that's more aligned to a tech company than maybe a bank is traditionally.
So, the banks really have legacy systems that they have had to deal with, and Macquarie thought if we could build a bank from scratch that doesn't have a lot of these legacy issues, where the experience is better, where mortgage turnaround times are faster, if we hire good people, we can actually build this and make it work.
And they did just that. They made a series of key executive hires from overseas to really help execute the plan. And according to insiders who are a big part of this push, Macquarie then did what it always does really well, and that's plough a whole lot of resources and focus into this plan in a relatively short amount of time.
And James, this is a different approach, isn't it? Rather than look to what their local banking rivals were doing, they look to the US tech giants.
Well, that's right. I mean, part of that is that you've got to think about what the local bank rivals look like. You know, they're mainly 100-year-old institutions. Their tech systems aren't beautifully architectured bits of software and hardware. They're like layers of spaghetti on top of layers of spaghetti. They're just being cobbled together to try and get the best results. But Macquarie could start with a blank sheet of paper. And not just on the tech side. I mean, these guys have no branches. They have no regional branches, so they're not carrying this big expense like the other banks are doing. At the start, they didn't have deposits. They didn't have all of the same regulatory burdens or obligations that the big banks had. And so they started from a very different place. They don't think like a traditional mainstream bank because they're not, and that gives them a real advantage. So you get less people, better tech, less friction in the banking business, completely digital, no branches, and so that just makes your proposition very, very different to what other competitors are offering.
Yeah, and it did work for them, didn't it, Joyce?
Yeah, well, it did. They did start to get traction. It wasn't sort of instantaneous and a big bang sort of approach like Mark Burris had been talking about, but they did sort of chip away at the dominance of the big four banks. And, you know, they now have a bit over 7% of the market in mortgages, and that's double where it was 5 years ago and is up from just 1.8% a decade ago. So they have built a really significant share from a standing start, and that's why the big banks are sitting up now and taking notice. UBS analyst John Story thinks Macquarie could overtake ANZ to become the nation's fourth largest home lender in about 4 years. Now, that's pretty remarkable. The proviso to that, of course, is if Macquarie keeps growing at the same rate. ANZ currently has about 14% share, so it's certainly not going to be an easy task for Macquarie over the next 4 years.
But if all goes to plan, if they do keep growing at that rate, Macquarie will be a big four bank, in terms of mortgages anyway, by 2030. James, how have the big banks, Macquarie's rivals, reacted? How worried are they?
Well, I think they've reacted slowly at first, and then all of a sudden they've had to react a lot faster. As Joyce said, the Macquarie's sort of push didn't gain immediate traction. For a while, I think they were one of many lenders in the broking market offering mortgages that all sort of look alike. But I think that's really changed in the last 5 years. We've had this home loan lending boom coming out of the pandemic, big rise in house prices, which means bigger loans, and Macquarie's really stepped into that and built its market share. I think the big banks, in some ways, they've sort of allowed themselves to be disrupted, partly by Macquarie, but more by this mortgage broking industry. I mean, 75%, 3 in 4 of all home loans now are written via a mortgage broker.
Yeah.
And that just means that the big banks don't have the same control, the same grip on the market that they once did. And that has allowed companies like Macquarie, who have good relationships with brokers and have done a really good job in terms of pricing, yes, but also turnaround times, which are very important to mortgage brokers. That's allowed Macquarie really to get in, get a foothold and steadily build this market share. I mean, to give you a sense of how important Macquarie's become in the market, a few years ago we saw ANZ trying to buy the banking division of Suncorp. Now, originally the ACCC blocked that deal. Then it went to the Australian Competition Tribunal. And lo and behold, the Australian Competition Tribunal agreed to green light the deal on the basis that Macquarie had acted as a quote-unquote maverick in the mortgage market and created such a level of disruption that the old rules of competition sort of didn't apply anymore. So it's remarkable to see how that's changed. I think the other thing that Macquarie has done is not just win any old customers, they've won the best customers. They've specifically gone after customers that are wealthier than the average, and therefore are lower risk than the average. And so the banks are not only are losing market share, but they're losing those really good customers that you always want to have. And I think that's why Commonwealth Bank's been particularly upset. They're the biggest home loan lender in the country, and they're seeing not only their market share being chipped away at by Macquarie, but again, Macquarie taking some of these really top quality customers in the market.
James, you're absolutely right there. Macquarie has targeted customers that typically have much larger deposits on average, and I think that's where the banks are sort of feeling a little bit uneasy about what Macquarie's been able to achieve. CBA has been going to great lengths behind the scenes to retain customers. If people go into a branch and say, I'm looking at this Macquarie rate, I want to move my money, or even if they do it online, CBA has been pulling out the stops to retain customers with a better deal to try and hang on to them. And that can be a couple of percentage points higher in terms of a deposit rate. So it really has created a reaction from the big four banks as they see this threat and try and retain customers where they need to. You can tell they're worried because also some of the comments that are coming out of some of the major bank CEOs. Earlier this year, Matt Comyn, without mentioning Macquarie specifically, effectively complained that Macquarie had an easier regulatory ride than the big four banks. Macquarie does pay a banking levy, and that's levied on the big five banks, and it's paid to the federal government every year based on the level of deposits in its deposit book. But the company is not deemed a domestically systemic important bank. So there is a discrepancy there with the capital that the big four banks have to hold versus Macquarie. Macquarie has to pay less, and that's where some of the tension and the friction is coming in. So what Matt Comyn was saying was that it's not a level playing field with Macquarie because they don't have the capital requirements that the big four do.
Now, we should say here, Joyce, that Macquarie sort of defends itself against those claims. There's a lot of stuff that goes on behind the scenes about trying to explain who's got what capital advantages. But not long after those comments from Matt Comyn around the competitive set, I found myself on a panel at the AFR's Business Summit where both Matt and the CEO of Macquarie, Shamara Wickramanayake, were on the same panel.
Okay, how was that?
Look, they're very respectful of each other and said so on the panel. But when we were talking about competition and how intense competition was, Shamara made a really interesting comment.
Shamara just said that CBA is hungry for market share. I think Macquarie is too.
Almost half under her breath, where we were talking about the mortgage market, and she said,
as you well know,
Bring it on.
bring it on.
Right.
Now, that was very sort of un-Shamara. It was said in a relatively jokey way, but there's an element of the direct challenge about that. And I guess it represented the change in tone from Macquarie. They've gone from this sort of saying, oh, we're just a small part of the mortgage market, just a humble little bank having a go, to saying, bring it on to the biggest bank in the country. So you can see that's why the big banks are starting to pay more attention to Macquarie, and why Macquarie is having to talk a lot more about what their bank is and how it works and what their ambitions are. I mean, at the banking summit a few weeks after that, we had Macquarie's head of personal banking, Ben Perham.
We take a different approach.
Talking about
Our savings account has never had a conditional bonus rate.
how important deposits are to the Macquarie model.
We simply pay the interest rate that we advertise. No hoops and no catches.
I think the big four banks sort of hoped that Macquarie would have a limited role as a disruptor in the mortgage market once upon a time. But all of a sudden they're at 7% and they're growing fast. And as we said, one day they could be heading towards being one of the four biggest lenders in the country. And I think there's a genuine risk that could happen in the deposit market. So history says you ignore Macquarie's competitive threat at your peril.
We're talking about Macquarie's push into retail banking in Australia and what that means for its banking rivals and for customers. Joyce, Macquarie's not just going after mortgage market share, it's now aggressively going after deposits. Is it making much ground?
Well, it is, yes. In deposits, Macquarie is growing much faster than the other banks. At its full year results in May, Macquarie reported the deposit book had grown to $215 billion, a notable increase over the 12 months. And it has been that sort of consistent growth which has outpaced what the system growth has been. The bank is pushing hard in deposits, both transaction accounts and savings accounts. Term deposits are sort of the next frontier. Macquarie is now sort of marketing itself as the friend of consumers. It is a little bit strange that we have the millionaire's factory trying to look after the little guy be the friend of the consumer. But their transactions accounts are very compelling. Macquarie's standard transaction account pays an interest rate of 2.75%, and that essentially compares to the other big four banks paying zero on transaction accounts, and that's been the case for some time for the majors. On savings, as Ben Perham said at the Banking Summit, that no hoops and catches compared to the other banks being the majors, but even ING, for example, you do have to meet all sorts of criteria around, having a higher balance at the end of the month or conducting 5 transactions during that period to earn that bonus rate of interest. So the Big Four do offer lower base rate interest rates on transactions accounts. With savings accounts, they have a base rate but a bonus rate if you meet all those requirements. At a survey that was conducted earlier this month by CanStar, a consumer research group, they found that 41% of customers actually fail to meet the bonus conditions. So a lot of customers aren't actually earning that higher rate of interest, and that practice has drawn political scrutiny.
So, James, you wrote recently that this could be the competitive fight that bursts the banking bubble. Do you think it will?
Well, I think it's part of the issue that banks have got at the moment. I mean, deposits are really important to banks. The more deposits you can get, the less you have to go to money markets and borrow to go and write loans. So you want as many deposits as you can get because it's the lowest cost form of funding that you can get. So it's really important. But what we've seen over the last decades really is that the banks have become very reliant on deposits where they don't pay any interest on those deposits. Now, it's about 12% of total deposits for the top 4 banks, about $370 billion worth of money. So what Macquarie is doing is challenging what has been called those lazy deposits. And they're saying, hey, come to us. We'll give you not only a big savings rate, we'll also give you a very strong transaction rate, unlike what the big 4 banks are doing. So in the past, people have been too lazy to shop around, basically, and the banks have profited from that laziness. But now Macquarie is starting to shake this market up, and that's got real implications. John Story at UBS did some great numbers that if those deposits that the banks currently pay no interest on, if they had to pay 3% interest on them, then that would wipe 20% of the bank's earnings. That is a big hit.
Yeah.
If the banks had to pay 5% on those deposits, then 40% of their earnings disappear. So, those are very round numbers, but it shows you the threat. And, you look at what Macquarie is doing in deposits. They've gone from 5% 12 months ago to 6.3% today. That is a big jump. They are on the move and they are coming for the big banks. So that is a really important fight that the banks didn't really expect they had it on their hands 18 months ago.
And is it enough to burst the bubble?
Well, it's another factor that the banks are dealing with. So if you think about it, what else have we got? We've got interest rates rising and putting pressure on potentially on borrowers, and that could lead to an increase in bad debts, which the banks haven't seen probably the best part of a decade. And then you've got these changes in the federal budget, which make property investing a lot less attractive from a tax standpoint. And that's likely to hit the banks too. I mean, as much as 40% of the flow of new mortgages in the last 12 months has been to property investors. And that's expected to fall because the property investors now need much lower house prices to make a property investment work. So we're seeing the banks get squeezed from all ends. Their mortgage business is already being squeezed by incredible pressure, including from the likes of Macquarie. Now their deposit business is being squeezed. Now you have rates rising and you have the end of this long super cycle in housing that we've had thanks to strong property investment. So my view is the pressure cooker is just building for banks at the moment. Bank share prices are still pretty high, valuations are still pretty stretched. But, last year we had Matt Comyn, the Chief Executive of Commonwealth Bank, go to a parliamentary committee and say, hey guys, the economics of banking is not as super strong as you think it is. And I think that is being proven right. We are starting to see that there are some cracks in the economics of banking. Not terminal cracks. They're still making, in the case of CBA, $10 billion in profit a year. No one's going to give them much sympathy. But we've bid these bank share prices up to very elevated levels. And I guess what I'm saying is perhaps that bubble in bank share prices is likely to deflate now.
So as you say, James, this more aggressive competition in home loans and deposits comes at a very uncertain time for Australia's economy and its banking sector. So if it does pop the banking bubble, what happens then? Who wins? Who loses?
Well, margins will certainly be under pressure. If we get a slowdown in housing credit growth, which I haven't seen an economist that's not really predicting that, given we've got rising interest rates, pressures sort of building throughout the economy and potential for higher competitive intensity. Add to that the uncertainty around the CGT, negative gearing reforms that are coming through. That's all a concoction that spells more pressure in the system and more difficulty for banks in maintaining and also growing market share. Macquarie, Lisa, has a track record of really pulling back or exiting markets if the returns aren't there. So I don't think that'll be any different in retail banking. They're very mindful of this. Shamara at one of the AFR summits said, while the returns are there, Macquarie sees no constraints to growth. But I'm sure conversely, if that equation starts to change, that Macquarie will recut the numbers and rethink their particular strategy in whether it's mortgages or deposits.
Yeah, I think this is a bit of a moment for the way we think about banks and in a few different ways. I mean, this is a great moment to be a consumer. There's really never been a better time to go to your bank and say, I want a better deal on my mortgage or I want a better deal on my deposits. Because the competitive environment is so fierce, you'll probably get a few extra percentage points on or off your loan or your deposits just for turning up and waving your arm and saying, hey, give me a better deal. But I think the flip side of that is what does it mean for shareholders? Banks are 33% of the ASX 200. So we are all bank shareholders through, whether that's directly or through our super funds. And that's been a pretty good trade for us for the best part of a decade. I don't think it's going to be quite as good as trade in the next decade. The competitive pressure on margins, as Joyce says, is real and it's increasing. And then we've got some of these external shocks, the change to the budget, the prospect that rates will be higher for longer, and that we might see a bit of a bad debt cycle that we haven't had for a long time. It's a different time for the banks. They've had a pretty good run, as Australia has, for 30-odd years. And I think we're entering a period where it's just going to be tougher for them. And that's partly the external environment and it's partly disruptive competitors like Macquarie.
Thanks, James.
Thanks, Lisa.
Thanks, Joyce.
Thanks very much, Lisa.
Thanks for listening to The Fin. On the podcast today, Associate Editor Joyce Moullakis and Chanticleer columnist James Thomson. If you want to read more about Macquarie's push into retail banking, check out the show notes. The Fin is produced by Mandy Coulin. Head of audio is Alex Gow, who also composed our theme. And Fiona Buffini is Head of Premium Content. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. I'm Lisa Murray. See you next week.
The Australian Financial Review.